Investing is only for the rich and wealthy. Investing is way too complicated for the ordinary person. You need a lot of time, money, and knowledge to invest. This is what a lot of people commonly think. They don't want to invest for all these reasons and many more. However, in this video, we're going to talk a lot about myths and mistakes people make about investing, debunk them, and ways to avoid them. So let's get into it.
Stop wasting money on that dumb shit and instead put it in investment. I know it's tempting. You'll spend it and be broke again.
So getting right into myth number one that Ryan already talked about, investing is only for the rich and wealthy. That's simply not true. Investing is what makes you rich and wealthy, okay? Everyone starts from somewhere. There are a few trust fund babies out there, sure, and you can be like, oh, them, blah, blah, blah. But the reality is you're just going to put in a little bit of work, invest in yourself, and, invest your money into certain things. We got plenty of videos on that, so be sure to reference all those. But again, you don't have to be rich and wealthy to start. You need to start to become rich and wealthy.
Exactly. I can't remember the exact statistic or percentage, but Dave Ramsey's team did a massive study on millionaires, and I believe it was over 90%, if I'm not mistaken, of millionaires didn't come from money. Yeah. They built that saving. They built that through investing. Myth number two, investing is way too complicated for an ordinary person. Again, this is not correct. When it comes to investing, there are many avenues you can go to invest your money and make money.
How many?
Many.
Okay.
So in this case, it can definitely get complicated. You can definitely get in the weeds. You can definitely have analysis paralysis.
And you'll never know everything.
Exactly. So you want to do your best to diversify. You want to do your best to understand so you're not taken advantage of. But there are experts in this field for a reason. You could reach out, or you can have a financial advisor, any of those situations where you don't have to be the expert.
Yeah,
for
networking,
one, exactly.
All sorts of things.
And two, when it comes to being overly complicated, you can uncomplicate things. We've talked about this in many videos. Index funds, ETFs, mutual funds, all of these things are going to diversify for you.
Yeah.
And so you could have what's called a total market index fund, and basically it just has stocks that encompass every sector of the market. That way you're not too exposed to risk in any way, shape, or form.
Yeah.
And you just buy it and buy it and buy it, and over time it'll go up in value.
Yeah. You're not stressed like, I don't know what stock to buy. There's all these numbers and charts. I don't know what means what. They're like, oh, the expected versus what actually happened, and what is good, what's the cap rate, the interest rate over time. Like, some people are bullish, some people are bearish. Well, with an index or mutual fund, like Ryan said, diversified for you. Simplify it for yourself. There's a lot of ways to do that in a lot of different types of investments, okay?
Right.
But again, you don't have to be an expert. Learn along the way. That's what we're doing. Exactly. We're not experts in this field in any means. But we've gotten into it. We invest in stocks. We invest in our retirement. We're investing in real estate and everything. We definitely don't know everything there is to know about any of those spaces, but we've learned along the way. We've talked to people that are further along in their journey than us, do our own research and everything. So really, you can just kind of jump into this, learn, you're going to learn a lot of things, and, you may come across issues, but again, just reach out to those or look at those that, are already in that space, and you'll learn a lot.
Learn by doing.
Yeah. And kind of along with the last two myths, myth number three is just you need a lot of time, money, knowledge to be investing. That's just simply not true. There's so many tools. We've talked about in one of our previous videos about just investing your first $1,000 or investing your first couple $100.
Right.
Starting somewhere. There are resources out there, like, oh, I don't even have a budget yet. Well, there's a million budgeting apps out there. We're going to have a video about that. So be sure to keep an eye out for that one. There's a bunch of resources and tools at your disposal. You don't need a lot of time. It doesn't take much time to, even open up a brokerage account. That's probably going to be your longest part if you already have a general idea of what ETFs you're going for. Like, oh, the stock market's such a complicated thing because they see, little screenshots of Wall Street and all the charts and numbers flashing around, and everyone's on a phone call all the time trying to find the best deal. It's really not that complicated. It doesn't take that much time. And you can make a lot of it automated.
Yeah, exactly. So that's just what I was going to say was you can set up your bank account or your brokerage account to pull the money every week, every month, every year, whatever you want it to do, and it'll automatically pull the money. So again, you don't need the time in that aspect. It'll do it for you. You can also set up to when it pulls that money in certain brokerages to go ahead and invest that money. Buy this stock, buy this ETF, buy this index fund, buy whatever. So if you buy an ETF that tracks the S&P 500 every time consistently, it pulls the money and invests it. It pulls the money and invests it. You don't need any time. You don't need any knowledge. It's doing all the work for you. So if a company falls out of the top 500, a new one replaces it to keep that 500. You didn't have to do anything. You didn't need the knowledge. You didn't need the time. And most of the time, you can start as little as $1, I think. So you don't need the time, money, or knowledge. It's mostly as simple as that nowadays.
Yeah, you can buy fractions of shares, no issue anymore.
Exactly. Myth number 4, you can get rich quick by following the trends. While this you can, the odds of timing this market or timing the situation perfectly isn't easy. Most people can't do it, so it's not in your best interest. It's much easier to be in the market longer than to try and time the market. So if you try and follow the hottest trend like Bitcoin and you buy at one time, oh, it's going to go up in the future, and you only give it a month or so and it ends up dropping, you're in a lot of trouble. The odds of you, a newer person trying to get into this and time and be experts, it's even less likely. So it's not worth the time. It's not worth the effort. It's extremely hard to get in at the right time. And on top of that, where the gains happen or where you actually make the profit is when you sell. So if you don't know when to sell either, then you're even more, you're like, you know what, I'm a little in the hole. I'll just hold on to this till it recovers. We've made that mistake. Oftentimes just
there's no way it keeps going.
Yeah, exactly.
It does exactly that. Exactly. So I mean, there will be learning instances in that. I mean, everyone's subject to it a little bit. But, like Ryan was kind of saying, especially if you're trying to go less conventional, because a lot of people are like, I don't want to stay in the stock market for 20 years and, just increase my money by 10% every year.
Right.
I want to get rich quick scheme.
Yeah.
Like they're like, oh, I'll just buy an NFT. We all see how
that
the NFT market's
crypto,
going now,
NFT,
or like, oh, I'm going to invest into whatever little coin, Dogecoin, or, I'm following the trend of, oh, I'm going to buy GameStop, if you didn't time that correctly, because I bought a little GameStop and it did go up some. So that was a cool little thing.
That was such a quick timeline that it went up and kind of started coming down that you would have had to know exactly.
It dropped back down. I missed the peak. I still made a little bit of money, but it was, missed the timing perfectly. So, those kind of trendy things, it's very hard to actually make money in that. Chances are you'll be much better off in the long run with time in the market as opposed to timing the market, like Ryan said.
Exactly.
So those are just a few of the many myths that are out there about investing. Be sure to comment down below if you want us to mention some more myths and debunk those, or if you just have some that you've heard that you have found just simply aren't true. There's tons of those out there, but jumping into the mistakes that people are making in investing, which there's a ton of these too, but we're going to cover some of the bigger ones. Mistake number 1 is simply not investing with a plan. You don't have a clear plan for your money. I mean, we've harped on budgeting. That's your basic plan for your money right there.
Exactly.
But taking it into investing, you definitely need a plan, because if you don't have a plan, you're going to be stretched too thin. You don't know where any of your money is really. You're like, wait, I opened a Roth IRA at some point. When did I do that? I've only been focusing on my brokerage account. So you need to have a plan. It just makes everything smoother, easier to track. And while, we've talked about how you don't need too much time, knowledge, and money, you don't want to spread yourself too thin and make yourself spend all this time because you got to track down everything that you're dealing with.
Yeah, and you also got to think about if you have a plan like, okay, I'm going to plan to retire in 20 years, you have a deadline when you're going to start pulling money out. So I need to make this much return to retire in this much amount of time. You kind of can gauge that, okay, that means I might need to go a little bit riskier on investments, or I have 40, 50 years. I can let my money earn 7%. I don't need 10 or 15%. And while that would be nice, but you could save the risk or less risk, more safety approach, get that almost guaranteed 7% in a loose term, because it's safer investments and just grow more over time. So if you could figure out what you're in, where you're entering the market, where you're exiting, where everything's at, again, you don't have to be an expert, but just having that plan, okay, I need to achieve this to get to this.
Yeah, and I was telling Ryan earlier that a quote I remember from one of the previous books I read, Atomic Habits, is like, everyone has the same goal, but winners, losers, they have the same goals. A lot of people want money. Some people are winners, some people are losers. What makes the difference is focusing on a plan and focusing on your system. That's why, just coming in here all willy-nilly doesn't work for most people. And it probably won't work for you unless you happen to get super lucky.
Right.
So having that plan just makes everything easier. You're able to keep on track better, and you're able to actually hit those goals.
So mistake number 2, which is very common to one of the myths we just mentioned, is following the crowd of the trends.
Yeah.
Just because you're seeing GameStop being talked about doesn't mean you got to immediately put your money in GameStop. And just because you hear, oh, Bitcoin's going to $1 million, oh, Bitcoin's going to $1 million, like, doesn't mean you have to invest in Bitcoin. You don't have to follow the media. You don't have to follow the trends. Follow what's tried and true, what's actually been proven historically to do well, what's actually performed or outperformed the market consistently.
I mean, we can attest to this personally. I mean, simply real estate investing as a whole, not everyone gets into that. And, it's not necessarily a trend because real estate's been around forever.
Right.
It has a little bit more difficult of an access point depending on what you're exactly trying to do. But, if you get into it, it's a great, opportunity to make wealth and generational wealth, which is what we see it as, an opportunity to reach financial freedom, escape the, classic 9-to-5 that you may not really be in love with. So, kind of going away from what a lot of people are doing and going on some tried and true path, like Ryan is saying, is really the better way. And this is what we're kind of our approach with real estate and everything.
over
So
time,
we're actually doing it ourselves.
Exactly. Over time, real estate's only historically gone up in value. Well, not only gone up in value,
Yeah,
but
yeah. There's
over time, right? Over the
as a
long
whole.
haul, it's gone up in value. And I believe over, what is it, 90% of millionaires own some form of real estate,
Yeah.
or have gotten to the millionaire status through real estate.
Mm-hmm.
So again, there's so many statistics and proven analytics, however you look at it, that real estate is a great investment.
Yeah.
And same with the stock market, depending on the timing and all of that, it can be a great investment. The S&P, for example, like we talked about, go into those. Don't go into the hottest current trend that nobody knows anything about.
Go ahead and look up, how many Dogecoin millionaires there are out there. There was that one guy who I think reached a few million. He held on to it too long, and now he's poor again. There are, videos on him and articles about him kind of thing. That's what the kind of trendy investing can sometimes get you. So you definitely have to, I'd say most times in reality. So you have to be careful with that kind of stuff. Yeah, guys, so mistake number 3, and it's our final mistake for this video. Again, there are more, so be sure to let us know if you want to know more mistakes that are out there. I mean, we've made a few ourselves, but not understanding the taxes and fees that go into all these investments and everything, because the reality is they're out there, okay?
Right.
I mean, you're like, oh, I'm going to get into investing. I bought, GameStop at this price. A month later, it's still high. I'm going to sell it. Well, that's a short-term capital gain. You're going to have to pay a higher rate than if you held it long-term, which you would have done had you bought something like the S&P 500. You would have held that probably for a much longer time than one of these little trendy things. Those tax rates are so much higher for those short-term capital gains. You also need to understand some of the fees that are out there. Like some people get into investing, they're like, well, if something goes wrong, I'll just take my money back out kind of thing. There's a whole bunch of fees in that. I mean, simply investing in your retirement, let's say you opened a Roth IRA and you're like, oh, I need $1,000 back kind of thing, and you pull it out. If that wasn't part of your initial and it was actually part of your gains, now you're paying a high tax rate on that too. So you're not getting all your money back out. So there's all these little fees and taxes that can really eat away from your profits if you don't have a plan and you don't understand the taxes and fees that go along with these things.
And we're not necessarily saying you need to go out and become an expert in this. We're just saying reach out to an expert, talk to a financial advisor, talk to a CPA, someone that does this often and can explain the fee structure, can explain all of these things. I think a good CPA typically costs $500. I don't necessarily know about a financial advisor. I think they normally take a portion, a percentage. But again, that's a fee. You should know that fee. If they're managing your portfolio and they're making 10%, but they're only taking a small fee, that's good. Like that's something you want. So that's what you got to figure out. Or investing in something that's actively managed, meaning someone's behind the trades and moving things around. That's going to be that's going to be a much higher fee than if you had something just kind of automated, like the S&P 500, that is going to drop a stock and bring in a stock automatically. Someone doesn't have to actively manage it. And most times these brokerages will have you click a stock you're looking at, you're interested in, it'll tell, or an ETF, a mutual fund, it'll tell you if it's actively managed or not. And you can also look at the fee typically there too. So just know those, have a general idea or general understanding of that concept. Oh, this one might be actively managed, or it says it, that means it's probably going to have a higher fee. Don't have to be an expert and know all the ins and outs. Reach out to an expert. But in that case, just have a general idea.
Because they'll be able to advise you on some of those things, like how I mentioned early withdrawals from a retirement account, or selling your stock too early. Or, some people think in their head like, oh, crypto is like an online thing and Bitcoin can't be traced and all this. So there's no way that I'm being taxed on those, the buying and selling of crypto. You are. So just being aware of some of those facts, that maybe in your head they're like, there's probably nothing or something little, or, maybe doesn't exist. In reality, it does. And suddenly you're either, doing your taxes wrong or something like that, and you can get in trouble, or you just like, where'd all my money go? I just tried to withdraw this, but I'm getting this, and all these fees are getting taken out. What's happening, kind of thing. So you got to be able to understand that.
Yeah, and people can be taken advantage of so easily when they're getting started and they don't know the fees, or they don't ask. All you got to do is ask most of the time and try and figure out. So we definitely don't want that to happen. And as always, we thought this was a good idea. We're trying to not make mistakes and run into these pitfalls. So in our research, we wanted to show you guys in an educational sense and show you what we've kind of gathered and go, okay, that makes sense. Or, oh yeah, we've made that mistake. Let's not do that again.
A lot of this we've come across personally, or made these mistakes personally at some point early on in our journey. And again, we're talking about myths and mistakes and everything. Don't be afraid to make mistakes, all right? It's kind of part of the game. You're going to learn a lot from them. But if you can avoid some of these bigger ones, we'd be more than happy to help you guys with that. So again, be sure to leave any comments for mistakes that are out there. We've come across plenty ourselves, made them. Don't be afraid to make them. But of course, try and avoid them when you can.
So please let us know in the comments if you guys like this type of content. We'd love to make more of these. We really enjoyed researching this and kind of debunking this ourselves, or doing the research. And so, let us know. Like this video, share with a friend, comment below, and stay tuned for the next one. Another week, we got another video.
Appreciate it, guys.
Stop wasting money on that dumb shit and instead put it in investment. I know it's tempting. You'll spend it and be broke again.